Picture this. Alibaba just threw another $50 billion into the AI bonfire, and suddenly Wall Street smells like fireworks again. NASDAQ futures are glowing, S&P is warming up, and the Dow, oh, well, it's tagging along like the friend who didn't study but still passes the exam.
That's actually a pretty good analogy. It really captures the weird split we're seeing, doesn't it? This huge, almost crazy surge of money pouring into AI, big announcements, strong earnings. That's the fireworks part.
Okay.
Then underneath, you've got this heavy macro stuff, the Fed being cautious. It's like an anchor dragging behind.
Exactly. And that's what we're diving into today, using the sources you sent over. On one side, this unbelievable AI arms race pushing tech up.
Mm-hmm.
And on the other, the macro worries, Fed warnings, disagreements about rates, maybe even a government shutdown looming. It's like we're sprinting full speed ahead on tech enthusiasm.
Well, dragging this big, heavy anchor. Yeah. And this morning, Wednesday pre-bell, that tech optimism was definitely winning out. Looking at the futures, NASDAQ NQSF was up a solid 0.25%, 0.25%.
Okay.
And the S&P 500 contracts, ESF, they were up to about 0.2%.
That's quite a turnaround considering yesterday things kind of stalled out, right? Broke that win streak.
Yeah, exactly. Tuesday saw losses, mostly in those big, magnificent 7 tech names that put a bit of a damper on things.
But the energy's back today.
It is, but it's very focused. That's the key thing here. The rebound is almost all about this AI investment story.
Yeah.
Because if you look at the Dow futures, YMF, they're barely up, maybe 0.1%. They have fewer of those big tech AI-linked companies.
So it's not the whole market celebrating. It's very specific.
Highly specific, sector-driven. It's all about where the big money is flowing. And that takes us straight to Asia and that huge Alibaba news.
Okay, yeah, let's unpack that. Alibaba stock, BBA, jumped, what was it, over 9% pre-market?
Over 9%, yeah. Huge pop.
And the trigger was them saying they're going to spend even more on AI than they already planned, which is already a ton of money.
A gargantuan amount already, yeah. And now they're hiking it. It's exactly like you said, an arms race mentality.
So why the increase? What's the thinking there?
Well, according to their CEO, Eddie Wu, it's basically about survival, keeping up. They had already earmarked, over 380 billion yuan? That's roughly 53 billion US dollars over 3 years.
Right, for their AI models, infrastructure, the whole deal.
Exactly. And now Wu is saying, essentially, that's not enough. We need to spend more than that to stay competitive globally.
Which kind of makes you wonder about the original target if they're already saying they need to overshoot it.
It does. But the number that really grabbed everyone's attention, the context Wu gave, was his projection for global AI investment.
The $4 trillion figure.
Yeah, get this. He projects global AI investment will hit $4 trillion worldwide over the next 5 years.
$4 trillion. That's almost hard to wrap your head around.
It's absolutely mind-boggling. And that's what Wall Street is latching onto. It makes this more than just a company budget update. It signals like an industrial revolution scale spending cycle.
Wow.
$4 trillion, that's close to the entire GDP of Germany, if that number is even close to accurate. The impact on everything, semiconductors, power, you name it, it's transformative.
So what are they actually planning to do with all this extra cash? Just buying stacks of Nvidia chips?
Oh, it's way more than that. Their goal seems to be full stack AI. They're developing their own Quen models, the big language models.
Okay.
But they're also focused on building the underlying tech themselves, like designing their own AI chips. Full stack means controlling it all, from the silicon chip up to the software and the cloud service. It's the playbook Amazon and Google used.
And they're expanding geographically too, right? That points to the scale of this.
Definitely. They're pushing their cloud division hard. They already operate globally, but they announced new data centers coming online soon in totally new markets for them: Brazil, France, and the Netherlands.
Just setting up shop in those places requires massive investment. Energy, servers.
Hundreds of millions, easily. Maybe billions, just for those initial footprints across 3 continents. It's huge.
And the ripple effect was immediate, wasn't it? It wasn't just Alibaba's stock moving.
Not at all. That spending news, that projection out of China, it lifted other Chinese chip-related companies right away. ACM Research, a key supplier, jumped like 15% in Shanghai.
Wow.
And NetUI technology was up 10%. It shows the money isn't just going to Alibaba, it's flowing through the whole supply chain. The market sees this as real investment.
Okay, so the market believes the spending is real, it's necessary, front-loading capital for the future.
Exactly. And if Alibaba gives us the spending signal, Then Micron technology, well, they gave us the demand signal. Their earnings were stronger than expected too, adding to the bullishness.
Right, Micron. And their management comments. That seems like a really key piece of the puzzle here. It's actual evidence of bottlenecks, right? Not just projections.
Absolutely critical insight. It came directly from Micron execs talking about demand, especially from the big hyperscalers, the companies building those giant AI data farms.
What did they say?
They basically said these huge companies are running into unexpected, significant shortages of storage for their AI servers.
Storage shortages. And specifically, they mentioned a problem with older tech, didn't they? The traditional hard disk drives, HDDs.
That's the bottleneck, yeah. HDEs, the ones with the spinning platters, they just can't keep up.
Mm.
AI needs super fast, parallel access to enormous data sets.
Right, for training the models and running them.
Exactly, and the mechanical nature of HDDs, the latency, the slow read-write speeds, it just doesn't cut it for modern AI. It cripples the speed.
So if the old spinning drives are the problem, what's the solution? What does that mean for the storage market?
Well, the direct implication is a big, faster-than-expected shift towards NAND SSDs, solid-state drives, and servers and data centers.
Because they're faster, use flash memory.
Much faster, lower latency, less power draw. Perfect for AI. Micron sees this shift as so fundamental, so structural, that they're actually predicting industry conditions for NAND will start improving specifically in calendar year 2026 because of this.
Wait, 2026? If the demand is hitting now, why are they forecasting the improvement so far out? Does that mean the spending is kind of ahead of the actual ability to build and install this stuff?
That's a really sharp question. And yeah, the answer is basically manufacturing lead times. Building new factories, new fabs for advanced NAND chips takes years, not months.
Oh, okay.
So that 2026 timeline reflects the lag. You have the huge spending commitments now, like Alibaba's pledge, but it takes time to actually get that new storage capacity built, tested, and deployed into data centers.
So it tells you two things. Demand is outstripping supply right now.
Right. And second, this isn't just a quick boom. It's a sustained multi-year investment cycle.
Okay, that makes sense. And you can't really talk about massive AI capacity without mentioning that huge reported deal, the $100 billion one between Nvidia and OpenAI.
Exactly. You put it all together, Alibaba's spending pledge, Micron confirming the physical storage bottleneck, and then this monster deal between the key chip supplier, Nvidia, and the key AI developer, OpenAI.
It's like a triple confirmation.
It really is, if you synthesize all that. The case for AI-related semiconductor stocks just looks incredibly strong right now. You've got the investment flowing, you've got proof of scarcity from Micron, you've got these massive partnerships locking in future demand.
So companies like Nvidia, AMD, Micron itself, the tailwinds are there.
Very difficult to argue against it at the moment. The money's flowing, and the physical constraints confirm the demand is real and likely sustainable.
Okay, but all this building, the chips, the storage, it leads to another maybe less obvious cost, right? The power issue.
Yes. The elephant in the server room, power.
This AI race isn't just silicon, it's watts. And that's putting a huge strain on something much older than chip fabs, the U.S. power grid.
This is potentially the next big bottleneck and where you see a secondary market opportunity emerging. It's enormous. There was research mentioned from Lawrence Berkeley National Lab.
Yeah.
They project energy demand just from data centers will double by 2028. Double.
And that's an insane growth rate, and the grid just isn't ready for it.
Not even close. It's not just about generating more power overall, it's the logistics. The grid infrastructure is old. If you want to build a huge new data center, you can face years, literally years, waiting in line just to get connected.
Years-long queues. Because the local substations, the transmission lines, none of it was built for these massive concentrated power draws.
Exactly. It's fundamentally unequipped for this sudden exponential demand jump.
The big tech isn't going to wait around for years, right? What's the workaround?
They're going off-grid, or maybe more accurately, using dedicated on-site power generation. Basically bypassing the grid bottleneck by making their own electricity right there at the data center.
Okay, and what's powering that?
For reliable, scalable, and relatively quick-to-deploy power right now, natural gas is a prime candidate.
The sleeper trade of the AI boom.
Pretty much. It's reliable, it's available, the infrastructure to pipe it in often exists or is easier to build than massive grid upgrades, and it lets these tech giants skip those multi-year connection waits.
And companies are actually talking about this strategy.
Yeah, explicitly. The CEO of Williams Companies, Chad Zamarin, They operate pipelines, he was quoted, saying their focus is shifting to directly powering data center facilities so that they don't have to wait for these multi-year grid expansions.
Directly piping gas to the site to generate electricity there.
That's the model. Convert the gas to electricity right where you need it.
And the market seems to be noticing this. The stocks of these natural gas-related companies are doing pretty well.
They are. It looks like capital is rotating into names that solve this fundamental power problem for the AI build-out.
Which ones were mentioned?
Well, over the past year, Expand Energy, EXE, up over 24%. EQT Corporation, EQT, a huge producer, up more than 40%.
Well, 40% for EQT.
Yeah. Range Resources, RRC, up over 13%. And Williams, WMB, the pipeline company, focusing on this direct power model, they're up over 32%.
Those are really solid gains. It makes sense, connecting the grid limitations back to the hyperscaler spending. It makes the natural gas play feel less speculative, more like a necessary component.
It's the engine room, exactly. It offers a way to get exposure to the AI boom, but maybe without the same level of volatility you see in the semiconductor stocks themselves.
It's a classic secondary play. When one sector explodes, look at what enables it: storage, cooling, and definitely power.
And these natural gas companies are essentially selling reliable power capacity to some of the richest companies in the world now. That strengthens their long-term outlook considerably.
Okay, so we have this tech-driven volatility, the infrastructure spending volatility, but then there's pure political volatility stirring things up too. Let's switch gears completely away from data centers towards geopolitics and defense stocks.
Right, a big pivot. And what's striking here is that European defense stocks popped on a day when the broader European markets were actually down.
So, very specific catalyst. What was it?
It followed President Trump shifting his rhetoric pretty significantly on Russia-Ukraine conflict.
How so? What changed?
Well, the reports highlighted him suggesting Ukraine could actually regain all its territory. He called Russia a paper tiger. And he also mentioned something about returning to the original borders from where this war started being very much an option.
That sounds like a much more assertive stance, signaling potentially stronger, more decisive support for Ukraine.
That's how the market seemed to read it. It suggests a clearer path, maybe more Western backing. And this came after earlier comments where he'd suggested NATO should shoot down Russian military planes in NATO airspace. Though he did add a caveat, depends on the circumstance.
Still, the overall tone shift is towards escalation, or at least stronger defense.
And the implication is a greater willingness to defend, perhaps push back harder. That signal hit the European defense market immediately.
Which stocks moved?
Germany's Rheinmetall, RHMDE, a big one, rose 2%. Another German company, Hensoldt, and Sweden's AB both jumped over 4%. And in the UK, BAE Systems, BAL, was up about 1%.
So the market sees this top translating into more defense spending.
That seems to be the interpretation.
Yeah.
Higher sustained defense budgets, especially in Europe where countries are trying to meet those NATO spending targets anyway. These companies are positioned to benefit from long-term commitments and potentially increased immediate needs.
But hang on, this is all based on rhetoric, on political headlines from one individual. This feels inherently volatile, doesn't it? We should probably flag this as high risk.
Oh, absolutely. Huge caution flag. Defense spending itself relies on long-term government contracts, yes. But the spike we saw, that's pure headline reaction. Policy stances, political wins, they can shift incredibly quickly.
So maybe an opportunity, but one requiring very careful watching.
Definitely. These gains reflect the possibility of more spending, not a guarantee. Very high volatility potential.
Okay, so from geopolitical turbulence, let's turn back to the financial kind. The big one for Wall Street, the Federal Reserve. This seems to be the heart of that macro anger we talked about.
It really is. The whole debate around U.S. interest rate cuts. That's the central focus, the main source of anxiety right now. If AI is the accelerator, the Fed is definitely pumping the brakes, or at least tapping them.
Fed Chair Powell was speaking, right? What was his message?
He basically reiterated the cautious stance, proceeding cautiously on more rate cuts while still kind of leaving the door open for maybe more easing later.
But he also said something specific about stock valuations.
He did, and this was notable. He explicitly described stocks as fairly highly valued. You don't often hear a Fed chair make such a direct comment on market levels. It definitely comes across as a warning shot to the bulls.
And the reason for the caution is the economy still seems okay, despite maybe some cracks showing in the labor market, as he put it.
That's the rationale. But here's the thing. That very cautious stance seems to be causing some real disagreement within the Fed itself, just a week after they cut rates with only one person dissenting.
The unity is already fraying.
Significantly, it seems. And the focus is on that lone dissenter, the new Fed governor, Stephen Micron. His view is starkly different from Powell's caution.
How different? What's Micron arguing?
He basically thinks caution is the wrong approach right now. He's arguing the current interest rate level is way too high, that it's choking off economic activity unnecessarily. He sees the labor market as weakening faster than the consensus thinks.
So he sees the high rates themselves as a risk.
A direct risk to economic stability, yes. And he wasn't vague about what he wants. He apparently stated he thinks rates should be roughly 2 percentage points lower than they are now.
2% lower. That's massive. That's not tweaking policy. That's a U-turn.
It's a huge divergence. If the Fed actually did that, cut rates by 200 basis points, I mean, it would completely reprice everything. Stocks would likely soar, bonds too, the housing market would probably explode. Micron is essentially calling for aggressive stimulus.
Puts him completely at odds with Powell's slow and steady approach.
Directly at odds. And you have to consider the political backdrop here. Micron was the dissenter in September. His appointment came amid calls for lower rates, and he's on leave from a White House economic advisor role.
Suggesting maybe a political push behind his aggressive stance.
It certainly raises that question, and the key takeaway isn't just that he disagrees, it's that he's not just some fringe voice. He has political weight, his argument about high rates hurting growth resonates with many, and his influence could grow.
So he introduces instability into the Fed's narrative.
Exactly. It disrupts the carefully crafted messaging. The market now has to price in a higher chance that the Fed deviates from Powell's path one way or another. It adds uncertainty.
Okay, so the market's caught between Powell saying, easy does it, and Micron yelling, cut deep, which makes upcoming inflation data even more critical, right? The PCE number on Friday.
Absolutely crucial. Personal consumption expenditures, the Fed's preferred inflation measure. Wall Street is desperately hoping that report shows inflation behaving, staying cool enough to keep the hopes of maybe 2 more rate cuts this year alive.
And if it comes in hot.
If core PCE surprises to the upside, well, that could shatter those rate cut hopes pretty quickly. It would strengthen Powell's cautious hand and could easily trigger a sell-off on Friday. It's the big near-term test.
As if that wasn't enough macro anxiety, we also have the recurring threat of a U.S. government shutdown. Again.
Ugh, yes. The September 30th funding deadline is looming. It feels like Groundhog Day sometimes.
What's the sticking point this time? Same old story.
Pretty much boils down to Senate procedure and leverage. Republicans need 60 votes to get funding bills past a filibuster, but they only have 53 seats.
So they need Democratic votes.
Right, and Democrats are using that leverage to push for other things, like extending healthcare subsidies. That's created an impasse.
And the chances of a shutdown seem higher now.
The risk definitely went up when President Trump canceled a planned meeting with Democratic leaders. He posted something like he decided not to waste time meeting them.
Not exactly bridge building.
Not at all. So yeah, the risk of the first shutdown since, late 2018, early 2019, it's looking more real. While shutdowns historically have mixed impacts on the market, a long one just adds needless uncertainty right now.
So let me recap the big picture. We've got this incredibly optimistic, maybe even frothy tech future being promised, the $4 trillion AI wave driving chips, and surprisingly, natural gas.
Right.
And that's crashing head on to this really messy macro picture. A Fed that's internally divided and possibly politically influenced, plus the threat of a government shutdown.
That's the core tension. Tech euphoria versus macro dysfunction. It's a recipe for volatility, absolutely. Today's excitement could easily curdle if the macro news turns sour.
Okay. But it's not all about AI and the Fed, right? There are other bits of data and stock news.
Yeah, definitely still other things moving. Today, for instance, besides waiting for Friday's PCE, we got some housing data.
What came out?
Weekly MBA mortgage applications and August home sales figures, plus data on new home sales and building permits for August. Given all the uncertainty about interest rates, keeping an eye on housing is pretty important for gauging, the underlying strength of the consumer.
Makes sense. And any specific stock movers catching your eye beside the big AI and nat gas plays?
Well, one was absolutely wild. Lithium Americas. LAC.
Yeah, I saw that headline. What happened there? The stock soared. Like 64% pre-market. That's insane.
64%. Just exploded. The news was that the Trump administration is looking to take potentially up to a 10% equity stake in the company.
Wow. The government taking a stake.
Yeah. It's huge for a few reasons. One, it's obviously capital, but maybe more importantly, it's a massive strategic signal. It says the administration sees critical materials supply chains lithium for EVs and batteries as a vital national security issue.
So it de-risks the company massively and validates their projects. Huge vote of confidence.
Enormous. Okay, switching gears again. What about Detroit? General Motors, GM, had a good pre-market.
Right, GM was up about 3%. Positive analyst notes.
Yeah, UBS upgraded them to buy. They cited a better-than-expected outlook for margins, so despite worries about trade wars or tariffs,
They seem to be managing costs and pricing well.
apparently so. Better execution than the market may be feared, which is probably a positive sign for Ford F2. The sentiment tends to lift both.
So U.S. automakers navigating risks better than expected.
Okay.
What about commodities? Oil.
Oil prices were up for a second day, partly because an industry report showed U.S. crude inventories fell last week. That tightens the supply picture, pushes prices up.
And there was something about Iraq, too.
Yeah, that added to it. A stalled deal to get exports flowing again from the Kurdistan region. Apparently, producers there want debt guarantees from the main Iraqi government before they restart pipeline shipments to Turkey.
More localized political friction impacting supply.
Exactly. It halts exports, even temporarily, adds a bit of risk premium, and nudges prices higher. A good reminder that energy markets are always vulnerable to these regional political issues.
Definitely. Okay, before we wrap, let's just touch on the market's overall performance this month. It's been surprisingly strong, hasn't it? Considering September's reputation.
It really has been resilient. September is usually weak, often volatile. But the S&P 500, it hasn't had even a 2% drop in quite a while. Best run resisting those kinds of drops in over a year, I think.
In the actual gains.
Pretty robust. The market's up around 9% for the quarter and about 3.7% just for the month of September itself. It's really defied that historical seasonal weakness.
Powered mostly by that tech momentum. The AI story.
Primarily, yeah. That $4 trillion AI promise, plus the lingering hope that the Fed will eventually cut rates, even with Powell sounding cautious.
So it's been a September to remember, maybe for the wrong reasons, historically speaking. The market's just choosing to listen to Alibaba and Micron.
And tune out the Fed dissent and the shutdown clock, at least for now.
Which brings us back to that core tension. How long can that AI fire burn so bright before the macro reality, the Fed split, the politics, Friday's PCE report forces a reckoning?
That's the multi-trillion-dollar question, isn't it? Makes Friday's inflation data absolutely critical.
So whether you're chasing AI chips, fueling up on natural gas plays, or strapping on a defense-stock helmet, just remember, markets love headlines but hate hangovers. Trade smart, not emotional. And hey, nothing here is financial advice, just your friendly deep dive market chatter to keep your portfolio buzzing.
Well said. And hey, before you go, here's something to chew on. A little homework. If natural gas is the bridge fuel, right?
Yeah.
The necessary immediate fix to power this first wave of the AI build-out because it's scalable now. What comes after the bridge? What energy sources or technologies are being developed today to power the next generation of data centers in the 2030s and beyond? That's where the really long-term thinking needs to go.
So look past the immediate fix.
Yeah. Think about things like advanced hydrogen, maybe enhanced geothermal, small modular nuclear reactors. Who's working on those solutions for massive, reliable, maybe cleaner data center power down the road? That's where the next big energy trade might be hiding. Food for thought.